Hello and welcome to 10x Investments mid-year review for 2022. Today we will look at the performance of our multi-asset funds used in our pre- and post-retirement solutions. 2021 was a fantastic year in the markets, and 2022 has been characterized by increased volatility that has seen most growth assets deliver negative returns on a year-to-date basis. It's often at times like these when you see negative returns on your statements or alarming headlines in the newspapers that one is often left with more questions than answers, sometimes leading one to question well thought out long-term investment plans. Today, we hope to explain what's been happening in markets over the year to date to help contextualize your investment performance. Before we jump into the presentation, I would just like to say that all information in this webinar, as well as questions answered afterwards, are for information purposes only and do not constitute advice in terms of phase. So let's jump into it. What we'll be touching on today, we'll start by having a look at some of the themes driving markets over the first 6 months of the year. We'll then look at how that's impacted different asset class returns, how that rolls up into portfolio performance. We'll then look at a peer comparison to understand how the 10x portfolios have fared relative to our competitors, and touch on a brief outlook and things to focus on during times of volatile markets. So let's jump into it. Probably the biggest theme in the first 6 months of this year has been inflation. There's a good chance that you might have read some headlines about it. You certainly would have felt it at the fuel pumps locally. But really what we're seeing is not just inflation in South Africa, but broad-based inflation increasing across economies around the world. In the South African context, at June, it hit 7.4%, which is the highest that it's been in more than 12 years. The last time it was at this level was in about 2009, and well above the central point of the inflation targeting band of 4.5% that the Reserve Bank targets these days, and above that 6% upper bound. It's not constrained to South Africa. When we look at the US, inflation touched at 9.1% in June. Now, there are a couple of things to point out. I think that's quite remarkable about this, is that if you look at the last time US inflation was at this level, you would have to go back all the way to 1982. So more than 40 years, inflation in the US has been subdued below this level. And also, if you look clearly at the graph over here, what you can see is that the dark line is higher than the blue line. So inflation in the US is materially above what we were experiencing in South Africa. And if you look back over the last 40 years, there are very few seldom points in time where that has occurred. Now, there have been many factors that have contributed to inflation, both demand-driven and supply-driven. On the demand side, in the wake of COVID, there was massive monetary and fiscal stimulus that ultimately found its way into pockets of consumers on a global basis. We saw household savings rates and personal income skyrocket, and ultimately what this did was cause increased demand for goods and services. At a time when there was increased demand for goods, supply chains were impacted by COVID lockdowns, so many of these goods could not find consumers at the end point in the markets, which contributed to an increase in prices. Those supply chain constraints also impacted the ability for commodities to be shipped around the world, and we've seen commodities really, from COVID lows in 2020, increase materially over the last 2.5 years. Now, supply chains have been one aspect in terms of driving commodity prices. Another has been as investment has dried up for fossil fuels, exploration and production has declined, which has meant that the supply of many of these commodities has been somewhat constrained, and the normal reaction function to higher prices has not really followed through. And earlier this year, towards the end of February, when Russia invaded Ukraine, it really created the fuel on the inflationary fire that had been forming. Russia, a major commodity exporter, major energy exporter, with the sanctions imposed, saw kind of this the final kick up in commodity prices. So where are we sitting today from a commodity perspective? Well, on a broad-based commodity index, we're seeing prices that we haven't seen since about 2011. And that's really has been creating one of the strong underpins for global inflation. Now, inflation in and of itself can impact broader economic growth. You can think about it in a local context. With fuel prices going up, it means that you have less disposable income in your pockets at the end of the day. And having less disposable income means that you can spend less money on buying goods and services, which ultimately stimulates economic growth. So kind of high inflation can have an impact on broader growth. But I think the main key that we're seeing this year is the impact that inflation has on constraining monetary policy of global central banks. So the chart on the right-hand side looks at the US Fed funds rate, which is effectively the US interest rate, going back all the way to 2000. And we can see that the starting of the 2000s, interest rate was about above 6%. And as we moved into that tech sell-off following the early 2000s, they cut interest rates quite aggressively to stimulate the economy. We then went through the 2000s. The economy started heating up again around housing predominantly, and we saw what the central bank did was hike interest rates again. Going into the GFC global financial crisis in 2008, it was the first time the US central bank cut interest rates to zero, responding to the financial crisis, and then hold interest rates at zero for an extended period of time, hiking them from about 2016 through to 2018 again. And as we moved into COVID, we saw the same playbook played out with central banks around the world cutting interest rates to zero. Each time they were able to cut interest rates to zero to support, one, the broader economy, and two, broader asset markets, because inflation was somewhat constrained. So you can see the black line, which is US CPI, is effectively tracking the underlying green line, which is the Fed funds interest rate. And what's happened since the lows in 2020, with US inflation really skyrocketing to those 40-year highs, it's constrained the ability of central banks around the world to continue with easy monetary policy and has forced them to hike interest rates quite aggressively. And it's the hiking of those interest rates which has really seen markets around the world in the first 6 months of this year recalibrate what higher interest rates mean for broader asset prices. If we look at global bonds, through many years of low interest rates as well as asset purchases, it pushed bonds around the world, it pushed interest rates on bonds around the world to negative levels, and in some instances actually below zero. We can see at its peak when one looks at all the constituents in the Bloomberg Global Aggregate Bond Index, almost 30% of the AUM in that index, tracked by that index, consisted of negative yielding debt. And with higher interest rates this year, the spectre of higher inflation, we've seen interest rates across global bond markets increase quite materially, so that has dropped with only about less than 5% of bonds currently with a negative yield. Really what that means is the long extended period of easy money has left us. We can see on the chart here, the South African 10-year government bond and the US 10-year government bond both have had significant increases in interest rates since the beginning of the year. The US went from about 1.5% yield to about 3% yield, so effectively doubling the interest rate. On the 10-year South African government bond, that went from about 10% at the start of the year to about 11.2% as at the end of June. Now, if you think about what that means from an interest cost perspective, there's been about the move from 10 to 11.2 is about a 10% increase in interest costs. However, on the US side, the move from 1.5 to 3 is a 100% increase in interest costs. And it's really that factor which has been driving a lot of the risk-off environment. What's also quite important to note is that bond yields and bond prices are inversely related. So as yields on bonds increase, prices on bonds decrease. So by holding bonds in a period where yields have increased, investors would have lost capital. And that's what we've seen on a year-to-date basis. So holding bonds, which are typically a defensive asset class and often do relatively well when equities sell off, providing some of that ballast and cushion in the portfolio, acting often as a shock absorber, we haven't seen that this year. So 100 Rand invested in the Bloomberg Global Aggregate Bond Index would have decreased to 89 Rand over the first 6 months of this year. So that's 11% decline, and that is in Rand terms as well. So alongside the sell-off in bonds, we've seen global equities sell-off. MSCI World Index, 100 Rand invested in global developed market equities at the start of the year would have sold off to 82 Rand, so an 18% decline in Rand terms. And we've seen a similar picture in emerging markets. I think the key takeaway from this chart has been that there have really been nowhere to hide this year. Bonds have sold off, which are typically defensive asset classes. Equities have sold off, which are typically growth assets. And really, there hasn't been great diversification for typical balanced portfolios on a global perspective. When we look at the South African picture, what's quite interesting is that South African equities have been spared the worst of the sell-off on a year-to-date basis. And if we think about what has been driving that, really it's been removing the global stimulus, which has propelled markets to highs at the end of 2021. Over the last decade, we've seen this global stimulus, both monetary and fiscal, be quite pervasive across global markets, and South Africa hasn't really benefited from that. So it does make sense, as that stimulus is being removed from markets, that those parts of the market that really benefited from it the most are hurt the most, and those parts of the market that really didn't receive that much of a benefit have actually been shielded somewhat. However, that does come with one caveat, in that when you go into general risk-off environments, they often say, don't throw the baby out with the bathwater, but global risk-off, emerging markets are typically a high-risk asset class, and ultimately, if you see global markets sell off, local markets will sell off as well. But what we've been seeing is the extent to which they have sold off have not been as bad. At 10X, we place an immense amount of focus on building the right asset class exposures to deliver more predictable returns, to help achieve our investors, to help our investors achieve their investment objectives. As such, when we've looked at the SA equity component of our portfolios, we built our 10X Top 60 SA Equity Index, which consists of the 60 largest shares, but most importantly, it caps that at 6%. So one isn't overly exposed to any one asset class. And we've seen that diversification come into effect on a year-to-date basis. When compared to the broad JSE equity headline benchmark, which is the FTSE JSE All Share, the 10X Top 60 SA Equity Index is down only 5%, protecting investors during this period of volatility. Now, on a global basis, we've spoken about how equities have sold off, but that sell-off's actually been driven primarily by the increase in global bond yields. And this disconnect where historically for the last 20 to 30 years, whenever equities have sold off, bonds have provided that ballast and cushion. What we're looking at the chart today is a global 60-40 portfolio. So in dollar terms, what has a global balanced portfolio done? So 60% invested in stocks, 40% invested in bonds. And we're looking at returns to the first 6 months of every year going back to 1960. And what stands out from 2022 is the fact that the first 6 months of 2022 has been the worst return to a global 60-40 portfolio going back more than 60 years. It really highlights the fact that there's been nowhere to hide in asset allocation portfolios. Now, if we look at it from a South African perspective, we've mentioned how South Africa has been somewhat shielded from the worst of the global volatility. We've said part of that has been the fact that the starting yields and starting valuations on a South African basis did not benefit from global stimulus. And another aspect of that has been the high commodity prices that we've been speaking about. The chart that we're looking at here is effectively a chart of a broad-based export commodities from a South African context. So the main commodities that we export are gold, iron ore, coal, and platinum group metals like platinum, palladium, rhodium. And what we can see on the chart here is that starting in January 2021, so for the last 18 months, that export commodity basket rallied through the first half of 2021. It sold off towards the end of 2021. And since the beginning of the year has really delivered elevated prices, which ultimately means that the cost of that basket is materially higher. The large spike on the chart is where the Russian conflict kicked off, the Russian-Ukrainian conflict kicked off, and there was a really tightness in many of the commodities that we export, because Russia's a big exporter in those commodities. Now, as we export commodities, we earn more hard currency, which really plays into supporting the broader economy. Now, that is a positive. There's also a negative when we're looking at higher commodity prices, and that's what many people will feel at the petrol pumps. So the chart that we've now pulled up onto the screen shows you the rand price of oil, and you can see while our export basket has been increasing quite materially, our major commodity import has also been increasing materially, and we certainly have been feeling that at the fuel pumps. Post the end of June, the oil price has moderated somewhat. However, a lot of the relief that we felt was front-loaded, and there's still another 75 cents of the fuel levy to unwind as prices are set next month. Now, if we put this all together, what does it really mean? Well, we earn a certain amount of hard currency for our exports, and we pay away a certain amount of hard currency for our imports. And the blue bars on this chart effectively show exports minus imports. And high blue bars above the zero line indicate that we've been earning a lot more hard currency into the country than we've been paying away for our exports. The yellow line is a broad exchange rate measure, not against any one currency, but against a basket of currencies. And what might be quite surprising is that versus a basket of currencies, the rand has actually been relatively flat on a year-to-date basis. It's depreciated materially versus the dollar, but the reason why it has been flat versus a broad basket of currencies has primarily been because of that large trade surplus coming through. There's a second aspect as well from higher commodity prices. We know that there are many commodity companies listed on the JSE that operate in South Africa. Higher commodity prices mean that these companies are making excess profits, really strong profits, and that supports kind of the resources part of the market. But more importantly, it also supports the South African fiscus, because as these companies are making much higher profits, it means that they're paying much higher taxes. And what you can see is if you look at the grey line, going back to 2004, that's basically been the revenue line for the government, and the darker line has been the expenditure line. And you can see since about 2010, the government has been spending a lot more than it's been earning, and that's never a great position because the deficit needs to be funded by greater government borrowing. But following the worst part on that graph, which is really where those yellow bars are the highest, and that is ultimately where revenue was materially below spending, that kind of coincided with kind of the end of 2020 as a result of kind of much decreased revenue related to COVID. But since those lows, and as the commodity prices have been elevated and really delivering much materially higher prices, it's meant that there have been revenue surprises for the government. They've been raising much higher corporate taxes than they were expecting to, and ultimately that feeds into the broader fiscal picture, meaning that they have to borrow less to make up for the shortfall. So higher commodity prices have really been a net positive for South Africa, while they're driving inflation globally, which is resulting in broader market volatility. There is a positive underpin for South Africa, which shows that despite the fact that locally we've got stage 6 load shedding, we've been struggling to stimulate economic growth, the global picture often dominates what's happening locally. So I mentioned before that the dollar's been strong and the rand's actually been quite resilient against a broad basket of currencies. Over the 6 months to the end of June 2022, the rand depreciated about 2.6% to the dollar. So what we're showing on the chart here is actually the return to holding foreign currency. So a positive return is rand depreciation and a negative return is rand appreciation. The dollar has been really a wrecking ball in a global sense on a year-to-date basis. And we've seen broad-based currency weakness against the dollar. In fact, the rand's actually been stronger than, has strengthened against the Australian dollar, strengthened against the euro by about 5.5%, strengthened against the pound by about 8%, and against the Japanese yen at about close to 14% over the 6 months to the end of June, which I think is a picture that many South Africans may be surprised to understand. When we bring it closer to home in terms of the local equity markets, 100 Rand invested in the FTSE JSE Industrial 25, which typically is made up of your larger Rand hedge shares like British American Tobacco, Richemont, Naspers. That index is off nearly just over 16% on a year-to-date basis. So 100 Rand invested at the start of the year would have declined to close to 84 Rand at the end of June. The resources part of the market started the year off with a bang as we moved through to March with the Russian invasion and that spike in commodity prices. But since then, as commodity prices have somewhat moderated, that's been reflected in resource performance through to the end of June. And it's actually surprisingly the SA Inc. focused financials which has delivered the best returns over the year to date to the end of June. Primarily, that's about the base effects. So the expectations around local financial businesses were really low. They had quite aggressive provisions around COVID, and as those provisions unwound, we saw relatively strong performance for that sector of the market compared to other sectors. When we turn our attention to South African interest rates and cash, well, what we're looking at here on the chart, the 3-month JIBAR is effectively an indication of what returns one is receiving on cash, and we've plotted that against South African inflation going back to about 2013. Now, I think two things worth pointing out here is there was a long period from about 2016 sort of through all the way to about 2020 where inflation was declining and relatively benign and our interest rates were quite elevated. And in that context, cash was giving really strong real returns above inflation, at one point as high as CPI plus 3. As interest rates were cut into COVID, we saw that real returns to cash basically went to zero as the interest rate was about in line with inflation. And as we've had inflation tick up over the last year, we're now sitting with the fact that returns on cash are materially below inflation. And I think it's important to just spend about a minute or so thinking about cash in the context of the volatility that we've been experiencing on a year-to-date basis. Investing in cash certainly will help you sleep better at night. You're not going to see cash losing you money on your statement. However, when we look at where inflation is, and when we also contextualize that with our investment goals, if we're saving for the long term, looking to grow our wealth significantly above inflation, for instance, our high equity portfolio targets CPI plus 6.5, well, investing in cash is not aligned to achieving your investment objective. So while it may help you sleep better at night now, it actually sets you materially back in terms of achieving your investment outcomes. So one has to weigh up kind of the peace of mind factor at night versus how potentially sitting in cash detracts from your long-term investment goal. However, having said that, the prospective returns on cash are looking more attractive as we've had interest rate hikes through the year, the most recent being 75 points by the Reserve Bank. So whilst the returns on cash on a prospective basis will be better, they still are currently materially below inflation. When we look at South African bonds, what the chart is trying to show ultimately is it's taken all the different countries around the world and it's adjusted the yields on their government bonds for currency so that you can kind of look at on a like-for-like basis. And then it looks at the yield from that government bond on the vertical axis, and on the horizontal axis is the credit rating. And effectively, as one would expect, a worse credit rating, investors will need to be compensated with a higher yield for the risk associated with that. But what's quite interesting here is once accounting for the currency, the red circle around SAF is where South African government bonds are sitting. And what you can see relative to many peers out there in the market, there's a materially higher yield for the same credit rating when one compares ourselves against Brazil, and even a materially higher yield when one compares ourselves to countries with worse credit ratings like Russia and Turkey. The key takeaway from that is that one's being compensated for investing in South African government bonds and the risks associated to that on a much better basis than with many other government bonds around the world. So, when we take a look at asset class returns over the 6 months to the end of June 2022, the picture, which we've really touched on already, has been that global assets, even in Rand terms, have delivered materially negative returns. Developed market equities down close to 18%, emerging market equities down close to 14%, developed market properties down about 17.5%. The SA growth asset classes have been somewhat more resilient, but still delivering negative returns. SA property has been impacted by the rise in government bond yields, and SA equity, the well-diversified 10x Top 60 index, providing somewhat of better relative returns relative to alternative implementation options for that asset class. And that's the growth asset side of the asset classes in the portfolios. Growth assets are typically those assets that deliver those larger inflation-beating returns over the longer term, but are much more volatile over the shorter term. So as we go through periods of volatility, one can expect those growth asset classes to have short-term negative returns. And the defensive asset classes, typically, as the name implies, have been somewhat defensive in this environment, with positive returns to SA inflation-linked bonds, to SA cash, and to international cash, which is effectively that dollar exposure. Nominal bonds have delivered slightly negative returns as we've seen that increase in interest rates, but somewhat more muted than the growth asset side. When we put that together and we look at portfolio returns on a year-to-date basis, the high equity portfolio, which has the highest allocation to growth assets, has delivered about -7% over the 6 months to the end of June. Medium equity, just over -5%. Low equity, around -2.9%. And the defensive portfolio has delivered positive returns. And when one looks at kind of the picture from the bottom left to the top right with defensive, you can see that portfolios with a higher allocation to growth assets have much higher short-term volatility, and as a result are more appropriate for investors with a longer-term time horizon and the ability to ride out that volatility. The defensive portfolio has been a great place to be over the last 6 months with a positive return, but because it has a much higher weighting in defensive asset classes, it has a much lower long-term return expectation. And if you've got a long-term time horizon, whilst the last 6 months may have felt great, it might impact your ability to meet that longer-term objective. What we've also included in this chart as well is some international investment choices available to our living annuity clients. The high equity, medium equity, low equity, and defensive portfolios are Regulation 28 compliant, so can be used for pre-retirement and post-retirement. But the international investment choices are only available for our post-retirement clients. They have a much higher weighting in global assets, a much lower weighting in local assets. And as we've touched on today, we've seen what's happened to global asset classes, and as a result, those international investment choices have delivered deeper negative returns over the first 6 months of 2022. The international high equity at minus 11.4 and international medium equity at minus 10.3. But one can actually contextualize those returns against the global 60-40 portfolio that we've seen, where a global balanced portfolio has been down about 16% on the first 6 months of this year. When we take a look at a slightly longer term time horizon, we look at 1 year asset class returns to the end of June, we can see that it's really been the South African growth assets that have contributed to stronger returns over the last 12 months. Developed market asset classes have been roughly flat, and emerging market asset classes are deeply negative, primarily around the Chinese exposure in that. On the defensive part of the portfolio, we're seeing relatively pleasing returns to defensive asset classes. In an environment of increasing inflation, inflation-linked bonds typically tend to outperform nominal bonds, and that's what we've seen with a 10.7% return to inflation-linked bonds, a 1.2% return to nominal government bonds, and over a 12-month basis to the end of June, the rand has depreciated quite materially against the dollar at close to 15%. On a longer term basis, on a 5-year time horizon, here we can see developed market equities have been the primary driver, with similar returns across SA equity, EM equity, and developed market property. The only growth asset that's deeply negative on a 5-year basis has been SA property. And on the defensive side, we've seen the return to international cash roughly in line with that of inflation. SA cash, we spoke about that period of high returns above inflation and subsequently moderating cash rate. So on a 1-year basis at 3.8% versus the last 5 years at 5.5%, the return to cash has moderated retrospectively, but looking forward, that's set to improve. As we roll that into the longer term portfolio returns, the high equity portfolio, medium equity portfolio, low equity portfolio, and defensive portfolio have delivered very similar returns over the last 12 months. And the primary reason for that is we saw on the previous slide that growth assets have been relatively flat over the last 12 months, and defensive assets have really been the part of the portfolio that's been working over the last 12 months. So as we have that split between high growth asset allocation and high equity, all the way down to a high defensive allocation and defensive equity or defensive portfolio, that's led to kind of similar returns over the last 12 months. As we stretch that time horizon out, what one can see over 5 years is that the high equity portfolio has delivered returns above 8% per annum, higher than the lower equity portfolios. And on a 10-year time horizon, and this is key and important in times of volatility like now, being invested with appropriate asset allocation is really key to achieving longer term inflation beating returns. So the high equity portfolio over the last 10 years has delivered 10.3%. Relative to 10-year inflation at 5.2 is inflation, over inflation plus 5% over the last 10 years. Turning our attention quickly to the international investment choices in our living annuity, the returns to those investment choices over the last 1 year has been relatively similar for international high and medium equity at around about 2%. Over the last 5 years, returns to those international investment choices would have given you around 9%, and over the last 10 years, around 13.6% for the international high equity and 12.9% for the international medium equity. When we compare our returns to our peers, 100 Rand invested with the 10x high equity portfolio, our flagship multi-asset fund, since our inception would have grown to 390 Rand as at the end of June 2022. And when we compare that to the average of large managers in the Alexander Forbes Large Manager Watch, that 100 Rand would have only grown to 363 Rand. Where we've placed on a 1-year basis relative to our peers is roughly around the median at 5.3% relative to a median of 5.2%. And what's interesting here is you can see the wide range of returns between the best performing fund and the worst performing fund. Typically those wide ranging returns are because the best performing fund and the worst performing fund would probably be running a lot more concentrated portfolio exposed only to one outcome, and that's either worked for them or against them in the last 12 months. At 10x, we ensure that our portfolios are well diversified to deliver returns in different investment outcomes and different investment climates. On a 10-year basis, consistently delivering returns over the short term around the median has seen the 10x high equity portfolio deliver 10.3% over the last 10 years, relative to the median at about 9.9%. So that's about 40 basis points per annum above the median. And most importantly, that's before one considers the lower fees to our investment solution, which are typically lower than many of our peers. So on a net of fees basis, the picture improves even further. So when we talk about the outlook for 2020 for the rest of the year, what do we know? Well, we know that inflation is high, even though we are starting to see some signs of inflation moderating in the coming quarters. There's a lot of uncertainty around exactly what that path will look like. There's uncertainty around what central banks' reaction to inflation will be, whether they'll continue hiking interest rates quite aggressively or whether they'll take their foot off the pedal. And most importantly, what the impact of inflation and monetary policy will have on global economic growth. What this uncertainty boils down to is that one can expect heightened volatility to continue through to the end of 2022. And why that's quite important is that with high volatility, as we mentioned as we started the webinar today, one often can question long-term, well-thought-out investment plans. But key to ensuring that you stay the course is to try turn down the noise and understand what is your investment objective. If you're targeting long-term inflation-beating returns, you have to be invested in a portfolio with a high allocation to growth assets to deliver those inflation-beating returns over the longer term. What is the expectation if one has a high allocation to growth assets? Well, one can expect shorter-term volatility like we've experienced year to date. But if you know that that's part and parcel of investing to achieve your long-term investment objective, it's really key to stay the course through these periods so that you can benefit from future periods of stronger returns. If you have a short-term time horizon, well, then you shouldn't be invested in a portfolio with a high allocation to growth assets. Lower equity portfolios or defensive portfolios with a high allocation to defensive asset classes are appropriate for the time horizon that you are invested in. If we just have a look at what has been the impact of the market sell-off on a year-to-date basis, the chart that we're looking at here is price earnings ratios to the South African equity market as well as broad-based developed markets, the MSCI World. Both of those have moderated quite materially compared to where they started the year in 2022. From a South African perspective, valuations are actually quite near lows of 2020 as well as the global financial crisis in 2008. From a developed market perspective, they're materially better than where they started the year. However, they're still somewhat more elevated. And whilst valuations don't matter over the short term, sentiment certainly is a key determinant. When one goes back and looks at kind of empirical data historically, an environment of lower valuations and an environment of higher yields has always preceded periods of stronger returns. It's quite interesting if you actually look at this chart. If you go back all the way to 1994, the valuations were relatively similar for broad developed markets and South African markets. We then saw going through to around about 2000, South African valuations moderated quite materially. Developed markets increased quite materially through to the tech boom in the 2000s. And from that point in time, you saw basically the two valuations converge all the way through to around about 2010. We know that in the 2000s, developed markets delivered relatively low returns. South African equity markets delivered relatively strong returns. And then over the last decade, it was vice versa. South African equities delivered relatively benign returns, and developed markets have been where all the returns have been sourced. And if you look at that, pretty much all the way to about 2017, you saw the South African equity valuation tracking that of broader developed markets. And as a South African market, we have much higher risks associated being an emerging market. Many of us will be familiar with those. So actually, on a longer term basis, those risks should be discounted from a valuation perspective. Where we're sitting now, that gap is still relatively large compared to developed markets, and we see a similar picture relative to emerging markets as well. But the reason why I spent a couple of minutes talking about the current environment is that from both a yield perspective, we see that yields today are materially higher than they were at the start of the year with bonds. Valuations are materially lower today than they were at the start of the year. And both of those imply that longer term forward-looking returns from this point in time are certainly set on a prospective basis to be materially better than they were at the beginning of the year. Now, that doesn't say anything for what happens in the next 6 to 12 months, as sentiment typically dictates market direction over the shorter term. But on a longer term basis, it's really key to understand where we're sitting, especially when there may be considerations around switching out of growth assets that are designed to maximize the probability of longer term inflation beating returns. So we had a period of heightened volatility. There's lots of noise in the markets, interest rate hikes, inflation's coming through, central bank meetings. There's a lot of noise that can often distract you from your long-term investment goal. So what should one focus on during times of uncertainty? And actually not even during times of uncertainty, at all times. It's best to focus on those factors that you can directly control. You can't control what happens in the markets over the next 6 months, but you can control how you invest your money in terms of your asset allocation. Do you have a high allocation to growth assets, or do you have a high allocation to defensive assets? That decision should be driven by number one, your time horizon, and number two, your investment objective in terms of what type of returns you're seeking over the longer term. Always remain well diversified. It's something that we hold quite dear at 10X and is a key part of our investment strategy. We mentioned it in terms of our SA equity portfolio, but also across different asset classes, across different geographies, because then you're not overly exposed to any one outcome. You need to keep your fees low, because in all market conditions, lower fees ultimately means higher returns are kept in your portfolio for yourself. And most importantly, during times of volatility like we're experiencing currently, it's important to stay the course and not be distracted from your longer term investment objective. Thank you very much for joining us today. I think at times like these, it's always important just to go back to focus on those things that you have control over. Invest according to your time horizon. Ensure that your portfolios are well diversified. Keep your fees low. And most importantly, stay the course through periods of volatility. Thank you very much for joining.